Hedge funds lose $30 billion on VW Infinity Squeeze. December 9, 2018. Volkswagen Infinity Squeeze. The October 2008 short squeeze on shares of Volkswagen AG has since been referred to as the mother of all squeezes. It was also perhaps the earliest use of the term Infinity Squeeze. It was during the middle of the worst financial crisis since the Great Depression, and Volkswagen was increasingly being viewed as a potential bankruptcy candidate. In other words, Volkswagen was viewed as an exceptionally attractive short candidate. However, at very depth of the crisis, an orchestrated short squeeze on VW shares caused VW to briefly become the most valuable company in the world, worth more by market cap than Exxon Mobil. The VW Infinity Squeeze seemed entirely counterintuitive at the time. And that is exactly the point. All Infinity Squeezes are the result of heavy overshorting of shares, which then become difficult or impossible to cover. Such aggressive overshorting only occurs when the bear thesis against the fundamentals is conclusively strong and very well disseminated. In other words, stocks which appear to be the best short ideas are also the ones which often end up being most likely to see the most violent short squeezes. At the peak of the great financial crisis in October 2008, Volkswagen had been, rightfully, viewed as a high-probability bankruptcy candidate. Even before the crisis, heavily indebted VW had already been struggling financially, and in the midst of a crisis, demand for new cars would surely plummet. Despite its troubled financials and business prospects, VW had reported several quarters of slightly better than expected earnings, leaving its share price surprisingly elevated at over €300. Combined, these factors made VW a seemingly very attractive short candidate as the financial crisis unfolded in 2008. In fact, as the financial crisis unfolded in 2008, the entire auto sector was considered to be a highly attractive short trade. As a reminder, up until 2008, General Motors had been the largest automaker in the world for more than 70 years and had over 200,000 employees. But by December 2008, GM was being bailed out by the US government, and by 2009, GM had entered bankruptcy. Automaker Chrysler would file for bankruptcy at roughly the same time in 2009. Against this backdrop, in late 2008, a short bet on troubled Volkswagen seemed like an absolute no-brainer. How General Motors was really saved. The untold true story of the most important bankruptcy in U.S. history. Forbes, November 2013. Why did car sales drop so dramatically during the financial crisis? Kellogg's School of Management, April 2016. Catalyst for the Volkswagen squeeze. On October 26, 2008, rival automaker Porsche made a surprise announcement that it had increased its stake in VW to over 74%. It was a stealth move, made possible through the use of multiple purchases of cash-settled derivatives, which had been accumulated separately through different European investment banks. Porsche Heads for Domination Agreement, Porsche PR, October 2008. Prior to 2008, Porsche had already been a significant shareholder in VW. Then in October 2008, Porsche took its stake to 30%, even getting board approval to ultimately take that stake to over 50%. However, statements from Porsche at the time had led most investors to believe that Porsche would not be attempting a full-blown takeover. And in any event, during the financial crisis, luxury car maker Porsche was even more financially strained than VW. There seemed to be little risk of Porsche having any realistic ability to corner the market or its much larger rival VW. German automaker Porsche announced that it had raised its stake in Volkswagen to 30.9%, triggering a takeover bid under a German law requiring a company to bid for the entirety of any other company after acquiring more than 30% of its stock. Porsche announced it did not intend to take over VW, but was buying the stock as a way of protecting it from being dismantled by hedge funds. This Day in History, History.com, November 2009, Porsche Supervisory Board gives go-ahead for majority stake in VW, Porsche SE, March 2008, confusion over short versus float. Prior to the announcement from Porsche, and as the financial crisis was becoming more apparent, short interest in VW had been steadily rising. But even by October 2008, the short interest seemed not excessive, at just 12.8% of outstanding shares. But what the market failed to appreciate was that the true availability of tradable shares to cover those short positions was actually far lower than what many understood. Short sellers make VW the world's priciest firm, Reuters, October 2008. Prior to October 2008, Porsche alone had already controlled 30% of VW's shares. Next, the government fund of Lower Saxony, the home province of VW in Germany, owned an additional 20% of VW as a strategic stake.
Short sellers make VW the world's priciest firm. Reuters, October 2008, Porsche and VW. How Germany got revenge on hedge fund locusts. Telegraph, October 2008, VW goes from the Beetle to the world's most valuable company. The Guardian, October 2008, panic traders take VW shares on a wild ride. The New York Times, October 2008, Porsche wins. Everyone else loses. Big. As a result of its skillful financial engineering, Porsche netted itself more than $10 billion in profits in a matter of just a few short weeks. It was money that was badly needed by Porsche. Luxury car sales were plunging due to the crisis, and Porsche was already saddled with significant debt. On the other side of the trade, the hedge funds who had sold VW short quickly saw their collective losses exceed $30 billion. Hedge fund managers were literally in tears on the phone as they described a nuclear bomb going off in our faces. As a megacap company, the short sellers who had been involved in the VW trade included some of the best-known names in the hedge fund industry. This included David Einhorn of Greenlight Capital, Andreas Helverson of Viking Global, Paul Singer of Elliott Management, Glenn Krevlin of Glenhill Capital, Chris Benodi of Odie Asset Management, among others. SAC Capital's Steve Cohen had said that his fund alone had lost $250 million in just 1 week on VW. Steve Cohen tells Paul Tudor Jones about 2 worst days of his life. Business Insider, February 2011, various funds would end up filing civil suits against Porsche to attempt to recover their losses. But ultimately there would be no significant consequences to Porsche. Hedge funds seek $2.4 billion in damages from Porsche's owning family. Business Insider, February 2014, hedge funds' $1.4 billion Porsche lawsuit faces dismissal. Judge, Reuters, February 2015, Porsche Holding wins hedge fund lawsuit at Germany's top court. Industry Week, December 2016, know yourself, know your opponent. A hedge fund that made a few sports cars on the side. Markets will always be full of surprises. But in 2008, the actions by Porsche should likely not have come as a complete surprise. In fiscal 2007, Porsche earned 3 times as much money from trading derivatives as it did from selling cars, and most of these derivatives were on shares of VW. Of Porsche's €5.86 billion in pre-tax profits in 2007, €3.6 billion was from options trading, with only €1.05 billion from selling cars. Porsche's derivative trading activities were entirely obvious to the market, and had even drawn criticism from sell-side analysts. Analyst Stephen Cheetham of Sanford Bernstein said of Porsche, "It does look like a hedge fund." Another analyst said, "It is a hedge fund investing in just one stock." Porsche makes more money from options trading than from cars. Foreign Policy, November 2007, VW options power Porsche profits. Financial Times, November 2008, Porsche. The hedge fund that also made cars, Prisonomics, short squeeze makes VW world's most valuable company temporarily. Autobody News, October 2008. As a result of the squeeze on VW in 2008, Porsche made 8 times more from options trading than it had made from its core business of selling cars. Stone Cattle Road. As an observation, if someone really wanted to make Mexico pay for a gigantic wall on its northern border, the last thing one would do is go out and publicly tell everyone that this was their intention. Likewise, when Porsche set out to eviscerate the short sellers, Porsche made it a point, prior to the final announcement, to clearly downplay in public that it had any such intention of actually taking over VW. No one should have expected the Porsche to come out and advertise any intentions. This Day in History, History.com, November 2009, Wikipedia.org Wiki Stone Cattle Road. Show me the incentive, I will show you the outcome. In retrospect, Porsche's activities were somewhat predictable based on the incentives that had been given to its CEO. When Porsche CEO Wendelin Wiedeking came aboard in 1993, he was able to negotiate a contract that gave him almost 1% of the company's annual pre-tax profits as a bonus. At the time of Wiedeking's contract in 1993, Porsche was losing $150 million per year. In 2008, as a result of the VW Infinity Squeeze, Porsche earned a bottom-line profit of nearly €7 billion. For 2008 alone, CEO Wiedeking received a bonus of €80 million. He was then pushed out of Porsche in 2009, but was given an additional bonus of €50 million on his way out. Porsche chief executive pushed out with €50 million payoff. The Guardian, July 2009, has Porsche bitten off more than it can chew. Spiegel Online, April 2009, Porsche fails to swallow VW. Spiegel Online, May 2009.
Where is it? Oh, do you see it?
At the time of Wiedeking's departure in 2009, Porsche was now saddled with $19.8 billion in debt, primarily related to the pursuit of VW. Interest payments alone were $790 million per year, and Porsche needed $10 billion in debt refinancing at a time when banks were now closed to lending new money. However, by the end of 2009, Wiedeking had made the cover of Fortune magazine, being named European Businessman of the Year, sharing the cover with a mention of Steve Jobs. Conclusion: over the longer term, VW's share price ended up falling significantly. And over the long term, this outcome was certainly quite predictable. But from a financial standpoint, investors who shorted VW shares at what appeared to be the optimal time suffered very steep trading losses. Ultimately, the only thing that matters to investors is realized gains and losses. The market places zero value on any post dated "I told you so"